Hey, welcome and good morning. My name is Kevin Renne. I'm a wealth advisor with JFS on our Pittsburgh team. Thank you all for joining us this morning. At JFS, we're very fortunate to have access to many great internal experts and resources for our clients. We look through multiple planning lenses to help determine the best path forward for our clients. As planners, we carefully consider the tax implications for financial decisions and have an incredible tax team internally to assist in that process. We're equally as fortunate and thankful to have many great outside industry partners to connect with for their specific expertise and thoughts. We believe that a collaborative planning with the right subject matter experts puts clients in the best position for success. I'm thrilled today to be joined by Rob Frenz and Mary Duffy with Andersen Tax to share their thoughts on the tax policy, legislative agenda, and regulatory changes that are currently in the pipeline. We know this is a very fluid and closely watched topic, and there's no shortage for planning implications in the years to come. So this is timely, and we're eager to get started here. Before we do, just a couple quick items. You'll see at the bottom of your screen a Q&A box if you want to ask a question. We'll be fielding questions after the presentation, so feel free to type in a question and we'll get to those. And if we don't happen to get your question, we can certainly reach back out and connect on that. So with that, Rob, Mary, thanks again for joining us. I'll turn it over to you.
Hey, so my name's Rob Frenz. I'm a senior manager in the private client services practice of Andersen in our Pittsburgh office. Our practice is around proactive tax planning and compliance services for individuals, partnerships, corporations, estates, and trusts. And we became the Pittsburgh office of Andersen on 1/1/23. Our former firm went by the name of Schemmel, Cornick and Mooney, so you might be familiar with us from that. We're just happy to be here today, and I'll introduce Mary and we can get started. Mary Duffy is a managing director and head of Andersen's U.S. national tax practice. She is also a member of Andersen's U.S. board of directors. Mary advises clients on tax policy, legislative and regulatory changes, accounting methods, accounting issues arising in transactions, and the tax implications of private aircraft. Mary is a frequent speaker for the Tax Executive Institute, the Practicing Law Institute, and other events. Mary, take it away.
Thanks, Rob. Thanks, Kevin. It's a pleasure to be with you all here tonight. And please do submit your questions, and we'll try to accommodate those during the presentation. Rob mentioned, before I joined Andersen in 2013, I spent a couple years working on Capitol Hill as a part of the staff on the Joint Committee on Taxation, or you may hear of them as the JCT. The JCT is the nonpartisan committee in Congress that supports both House and Senate Republican and Democratic members with tax policy and tax legislation. So I got to see a little bit of how the sausage was made back then, and we'll share some of those insights from my own experience, as well as what I see going on today in Washington, D.C. And so today we're going to talk about, where we are in terms of the timeline and process for tax legislation, a little bit about the TCJA, and then I'm sure you're all very eager to hear about what is in the tax bill that passed the House just prior to the Memorial Day holiday. So I'll tell you, some highlights of what's in that bill. Okay, so in terms of where we're at now, if you had asked me before Inauguration Day, would we have a bill passed the House by Memorial Day, I would have been fairly shocked. President Trump did set out as a goal to have his one big beautiful reconciliation bill through the Congress within his first 100 days of being a president, but that was never really a realistic goal, and most people would have thought that this would take until later in the year. And with my own experience working for the Congress, They don't normally do something until they have to. You know, we saw the TCJA pass at the very end of the year. We often see things pass, you know, right before they're trying to leave for recess. That was the case here. They passed it before the Memorial Day recess, but they're kind of running ahead of schedule in terms of not what was the goal, but what was viewed to be realistic. So we did have, we'll talk a little bit about the budget resolutions. We did have a joint budget resolution on April 10th. And then the House bill passing May 22nd. They've set a goal of enactment of this legislation by July 4th. You know, they could prove the folks in Washington wrong, but that seems like a very aggressive goal. You know, maybe they can get something out of the Senate before July 4th, but a lot of folks would expect more likely to see something coming before the August recess. You know, kind of the have to do it time gets to be toward the end of the year when those TCJA items are set to expire. So in terms of the process, people probably know by now a lot more than we used to about budget reconciliation, because it's become so common as we see the control of the government toggle back and forth between all Republican and all Democratic. And so the point of using budget reconciliation is that you can avoid a filibuster in the Senate. You know, when you have a filibuster threat, you have to have 60 votes in the Senate. Republicans don't have 60 votes in the Senate. This reconciliation process allows a legislation to pass the Senate with a simple majority vote, but it comes with certain rules. So one rule is that you're not supposed to increase the deficit beyond the current year 10-year budget window. You can increase the deficit all you want during the current 10-year window, but not outside of it. And so historically, that's always been measured based on current law. And so what we, you know, you could handle that a lot of different ways, but, you know, what we've seen a lot is where you're doing tax cuts that they'll expire then at the end of a period. And that's how they handle dealing with that rule. And here we've seen the Republicans trying to take a different and novel approach. They're talking about, instead of a current law baseline, let's use a current policy baseline. And under current policy, all these TCJA cuts would just continue. And so extending them doesn't cost anything outside the 10-year window, because the policy is that they'd continue anyway, so the cost is zero. So that's a way to make it permanent. Okay. So a problem with that is the third bullet under the Byrd rule is under budget reconciliation, you can only include measures that have a fiscal impact. So if it's current policy that it's continuing and it doesn't cost anything to make it permanent, then does that even have a fiscal impact at all to meet the rules? So what we're seeing them do is, okay, we've got to have it have a budgetary impact. Under this novel theory, it doesn't. So we're going to have to tweak all the provisions so that they do have a budgetary impact. So that adds a lot of complexity. You know, we'll see more about how that's going to be handled as things move through the Senate. You know, some other things we'll see. You can't make changes to Social Security. We'll get to President Trump's promise on that a little bit later. And you can't include things that don't have a budget impact. So we could have a problem with this whole baseline. And then, you know, there could be provisions, and you're already starting to hear it come out of the media, that aren't really budgetary related. They're more social policy or other policy. The primary motivation isn't budget. And so those might get dropped off as this package moves through the Senate. Okay, now this slide, just making a comment that I think we're all used to seeing reconciliation now. Using reconciliation for tax legislation is extremely common. We see it happening almost every time the boxes line up with all red or all blue. That's how we got the TCJA changes in 2017. The Biden administration used reconciliation twice on their American Rescue Plan Act and the IRA, which had a lot of tax changes. And so it's just something quite common that we see again and again and again as the government flips from one side to the other with small margins. Okay, so in terms of where we're at, and so step one in a budget reconciliation is that you need to have a budget resolution. And so, this really kicked it off in terms of, okay, this thing is actually happening and moving. The House surprised everyone with actually being able to pass a budget reconciliation resolution back in March. That resolution tied tax cuts to spending cuts. And then it went over to the Senate. The Senate had originally embraced kind of a two-step process that would do border and defense now and address tax cuts later. But once the House passed one package, the Senate got on board and passed its own resolution that was different, but along the same lines as the House resolution. And then the House went ahead and just passed the Senate's resolution. But there are some fundamental areas of disagreement among Republicans on spending. These budget resolutions were vague enough that it was kind of like, okay, we disagree, but this will get us to the next step. So we're going to see a lot of this continue to play out as this thing moves through the Senate, is that they're not totally decided on the policy. And so the House bill is just a starting point. The House bill also only passed with one vote in the House. And the Senate only has a 3-vote majority. So people need to be mindful that, hey, the Senate may want to do some different things, but they're going to have to get something that can pass the House again. We've also seen a lot of energy from this Republican Party. We had the Ways and Means Committee went into their markup session at 2 p.m. on May 13, and they marked that bill up overnight, finally passing it out of the committee the next morning. Again, the House went in for voting like in the middle of the night on Wednesday and passed this through the House around 6:45 a.m. on a Thursday morning before Memorial Day. So we're seeing kind of them, working all night long and using exhaustion and just kind of making things go forward from, brute force as sort of their lack of sleep as their strategy. And so a lot of this goes back to the TCJA. I have on the screen the provisions in the TCJA that are expiring. You'll note that most of the expiring items are on the individual side. There were a few kind of business extenders that already expired, and then some of the foreign provisions that are expiring now. But really what we're talking about are the individual tax changes in terms of the TCJA. And a couple things to think about as we compare, well, what happened with the TCJA to what we're seeing now. So in 2017, the TCJA was really an aspirational work, a cumulative work. It was built on many years of work. When I was working for the Congress, we were working on different discussion drafts that were released to the public and commented on and really were out there. They didn't move forward, but they were out there and had a lot of work done for a number of years. And there was a real problem at the time. Our international tax system was not competitive. We had a 35% corporate rate. And there was this lockout effect with respect to foreign earnings, where companies wouldn't have to pay tax on foreign earnings unless they repatriated them. So they didn't repatriate them. We had a wave of corporate inversions where companies were changing their headquarters to overseas for tax reasons. And so there were a lot of problems that the TCJA was trying to address. Back then, the process was also driven by Congress. It wasn't driven by the president. Back then, President Trump's priorities were he wanted a 20% corporate rate. He wanted to solve that lockout problem, and he wanted to reduce middle class taxes. Now, this time, I would say the White House is quite a bit more animated in terms of their involvement in the process. President Trump, out on the campaign trail, promised lots of goodies on the tax code everywhere he went. He's got his own agenda. You know, I want to hit the NFL. I want to hit carried interest. And, you know, doing this all as one bill with all the spending and the tax together creates challenges versus doing tax as a separate item. And the debt is a much bigger problem. It's perceived as a much bigger problem than it was back then. You know, we've seen a lot of spending pile up through COVID and just, you know, huge deficits year after year after year. We had inflation. We have high interest rates now. Last year, our spending on interest to service the federal debt was more than our spending on our military. And they say that that kind of fact pattern tends to lead empires to fall. So a lot of members of Congress are very focused on debt. The other thing is they've tied extending the debt ceiling into this package. They're already using, you know, extraordinary measures to pay the bills. And so the debt ceiling, if it stays in this package and doesn't go on a separate track, really does set a real deadline to move this forward, you know, by sometime in mid-August. And then keep in mind, this is not really the same Republican Party that we saw back in 2017. They've definitely taken a populist turn. You know, last year, they were working on a bipartisan tax package that passed the House and ultimately didn't go anywhere in the Senate because of Senate Republicans. But a lot of House Republicans said, well, why can't we just raise the corporate rate? Why can't we raise the rate on top earners? This is just not your low tax Republicans that we used to see. There have been some cultural shifts where a lot of them are thinking about the little guy. How does this help the worker, and not as focused on, you know, how does this help big business? We've got a SALT problem. A lot of, you know, Republican House members in blue states have made promises around the SALT deduction. And then we have the overlay of the tariff turmoil and a lot of concerns about the economy. Okay, so in terms of President Trump's promises, you know, he was out on the campaign trail talking about taxes. You know, some of the items he promised was kind of go along with the TCJA items anyway, increasing expensing for small businesses, having R&D expensing. You know, he also made promises around the SALT cap. And so what we saw come out of the House, and we'll talk about this a little more, shows that this is really a Trump-driven process. The members of Congress are trying very hard to address really every single one of his promises. Many of these things, though, are arguably, you know, bad policy, go against the kind of lower the rate, broaden the base, you know, typical what we think of as good policy. So Congress may not really want to make these changes, or a lot of members may not really want to make these changes, but they are trying to provide, you know, narrow packages, narrow items that will address this. And so, you know, President Trump promised a 15% rate on domestic manufacturing. Instead, what we saw come out of the House package was an expensing provision for buildings used in manufacturing. You know, he promised no tax on overtime and no tax on tips. And so we saw a limited 4-year provision that would, in a narrow way, eliminate those taxes in certain industries with caps on income. Same thing with the car loan, domestic car loan interest. We saw really limited provision there. So they're trying their best to meet these promises without breaking the bank, because a lot of these things can be, kind of narrow, or it could be something, really big. I remember when I started my career at Arthur Andersen back in the 90s, we actually, CPAs actually got paid overtime. And so we're like, well, we could go back to that too. But the provision is limited to industries that typically pay overtime as of today. Okay, so some of the key things that we're seeing here on the individual side, we're seeing a permanent extension of the TCJA rates as they were. There had been talk about instituting a higher rate or letting the top rate expire. That is not in the House package, but I think is still something for discussion. On the salt cap, we saw a lot of drama around salt. They ended up with raising the cap to 40,000, but that's only for people with income under 400,000, which phases out between 400 and 500,000. Over 500,000, the salt goes back to the $10,000 that we had before. We saw, extension of AMT, extension of the increased charitable, extension of the opportunity zones. We talked already about the tips, the loan interest, and for seniors, they gave them an extra standard deduction rather than trying to make any kind of benefits non-taxable. We saw a lot of little changes to comp and benefits. And then, for our clients at Andersen, one of the most impactful things was this phase out on itemized deductions. And so this phase out, it's different from the old Ps, which you may remember. It doesn't, reduce down your itemized deductions completely, but what it does is it only allows a benefit of those deductions at 35% versus 37%. So this was a type of policy we saw coming out of the Obama administration. Wasn't enacted before, but it just takes a little bit of a haircut on those deductions so that they're only benefited at a 35% rate. Investment interest is excluded, but it would provide a haircut on charitable deductions. The mortgage interest provision as just makes permanent the TCJA change. On pass-through businesses, we did see some changes around the QBI 199 cap A. This was really a surprise where they increased the deduction to 23% from 20%. The lobbyists were not expecting that. They also made it permanent. So query whether that 23% will remain. They also, Trump had mentioned carried interest changes, but we didn't see any carried interest changes. What we did see was a rollback on the PTET. The PTET is the pass-through entity tax deduction, a sort of a workaround for businesses to elect to pay pass-through entity tax rather than individuals, which would have allowed the flow-through of a deduction of those taxes that would otherwise be subject to the SALT cap if paid by an individual. The provision would have, repealed or overturned Notice 2020-75, which is the IRS notice that provides authority, but did and then put in a statutory rule that would allow PTET for good 199A type businesses, but would disallow PTET for those specified service trades or businesses, and would also disallow PTET for non-businesses. So investment partnerships, higher tier partnerships would no longer be eligible for PTET. And, maybe with the QBI going up, they were trying to do a little bit of trading off with that PTET loss. It's my understanding that that PTET trim back does raise quite a bit of money. It's definitely something that people are lobbying over in the Senate. So we'll see what happens with that. Another big change we saw was for excess business losses. And so we're probably all familiar with the 461L provision that was brought in with the TCJA, where if you have an excess business loss that's in excess of $500,000, you can only offset it with business income, and then it would carry forward as an NOL. Under the current provision, it would carry forward as an NOL and be available the next year to offset any kind of income. This provision, it borrows from a provision that the Democrats had proposed and the way California does excess business loss, and treats the carry forward as again subject to that loss limit. So every year that carry forward is going back into that $500,000 limit. So it's a really potentially painful provision for entrepreneurs, serial entrepreneurs. We have a lot of them in our client base who may have a lot of investment income, but losses from starting up new businesses or, compensating people during COVID, or a lot of different things. So that's one that we're also watching closely and hearing a lot of chatter about. And then they would also eliminate the ability to charge taxes to capital account. It's just another way to circumvent this rule. They're trying to limit that. In terms of just regular businesses, so agnostic to whether it's a corporate business or a pass-through, they would reinstate bonus depreciation. Back to January 20, they would reinstate research expensing from 2025 to 29, but only for domestic research. Foreign research would continue to have to be capitalized and amortized over 15 years. They provided a new small business accounting threshold for manufacturers. The old threshold is 25 million. This would bring it up to 80 million for manufacturers. They gave that relief on your interest expense limitation. Starting in 2022, you couldn't add back to the base for that 30% limitation, amortization and depreciation. It would bring that back temporarily. And then there were a lot of things that they were talking about on businesses that were, rumors or things that they were investigating that were not included. One thing they talked about was, let's just eliminate SALT deductions across the board, even for corporations. Just take that off the table by eliminating it for everyone. They did not do that. They didn't increase the stock buyback excise tax rate. They didn't increase the corporate AMT. What they really did do was trim back a lot of the energy credits in the IRA by making those phase out or expire earlier. Let's see. Other things that were important. The charitable deduction for corporations, they set a 1% floor. So any deductions under 1% would just not be deductible anymore. They retroactively would eliminate those employee retention claims that were filed after January 31. There's been a lot of blowback about the broadness of that provision. And then to go to Trump's point about the NFL for newly acquired sports team assets, they would limit the intangible amortization to only 50% of what it would otherwise be. On the international side, kind of what we expected, they they went with the GILTI and the FDII rates and the BEAT rate. They tweaked these rates slightly from what they were before at the last minute. I think they were just trying to scramble and make the numbers work with the other changes they had. I don't know if those tweaks will stick or if they'll go back in the Senate to those full rates that we had before. And then they did something novel that's getting a lot of media attention. They put in a retaliatory tax regime. This retaliates against foreign governments or that are implementing these, Pillar 2 top-up taxes or digital service taxes that are really aimed at American companies. I don't think they're really trying to collect revenue with this. They're trying to send a message to these other governments like, hey, back off your taxes. So we'll see if that's an effective tool or not. And then they did propose a new or impose a new excise tax on individual remittances. So this is, got somebody here in the United States and they're sending money back home. The excise tax is 3.5%. There are there's an exception for anything under $15. There's also some exceptions for U.S. citizens, but this is one that we're hearing some concern about as well. And then they really did take a little swipe, I guess, at the tax exempt sector. And so, they did provide a few benefits to the tax exempt sector, but they really went after them for some revenue. So we're seeing private foundations had been subject to 1.39% excise tax on their net investment income. They put in a graduated schedule that goes up to 10% for foundations with assets over $5 billion. And then they also put in a tiered rate structure for private university endowments based on per student endowment, with a top rate of 21%. So they're really, I think, sending a message there, as well as collecting some revenue potentially from the tax exempt sector. And then finally on the estate and gift side, they, the estate and gift increase thresholds were scheduled to expire at the end of 2025. It would actually, instead of just making permanent the current thresholds, it would increase them to $15 million. It's my understanding that this is an important item for Majority Leader Thune in the Senate, and that we don't expect to see it rolled back. We may even see that threshold further increased in the Senate. And so, with that, I'll end my portion of the presentation with just a little bit of a scary picture. And so I mentioned to you that the debt situation is just different and more alarming than it was before. You can see, we just have, deficits projected as far as the eye can see. We have really high interest rates now, and there's a lot of concern about, is this sustainable? We saw the Trump administration go through a DOGE effort, but the truth is that discretionary spending is just a really small portion of what the federal government is spending. We've got mandatory spending, including interest, Social Security, and other benefits that are really the bulk of the spending. And so I think we'll see what happens, but it's definitely part of the conversation. I think they're going to kick the can again. They'll keep kicking it as long as they can, but it is something to watch over the longer term. And with that, I'll open it for questions.
Mary, thanks so much. A lot of good information there, and a lot to pay attention to in the coming months. But we did have a couple questions kind of come in, so I'll pose those for you. So the one was, is the intention of the enhanced standard deduction for seniors meant to help curtail the tax consequences of the Social Security, since that's not able to be included in the budget reconciliation rules?
I haven't heard anyone speak on this specifically, but my own reaction and understanding is exactly, they're trying to make a nod to President Trump's promise to end the taxation of Social Security benefits that he made out on the campaign trail. And the problem is, you can't do that through the budget reconciliation, because the income tax on Social Security is just not something they can change through those rules. They may not really actually want to do that anyway, but they're giving him a nod and saying, well, what we can do is give seniors a bigger deduction. A deduction can offset income. And so essentially it may be making, $4,000 of benefits tax-free by giving a deduction. Yeah. And then, you get it kind of the constituency that you want, because it's for people who are taking the standard deduction.
Right.
Yeah.
Right. Okay, good. Well, another question here. You had mentioned the deduction for home equity interest, would that, I guess, would that deduction be used for home equity improvements still deductible if under the $750,000 cap?
I think, Rob, you had a comment here. I mean, they've always been separate
It's
items.
always been a separate limitation, and that hasn't changed, right? I mean, you wouldn't include home equity indebtedness under the 750,000, but previously, currently. So
Yeah,
Yeah.
it has to be original acquisition and indebtedness.
Okay.
Yeah.
Good. Well, just some clarification there. Another one here is more with the pass-through entities, which, I know you had mentioned, some of the small businesses will benefit from the increased deductions, but there may be planning opportunities. With the elimination of the pass-through entity tax deduction for specific professional services, providers, are there items in the bill being viewed to kind of offset that? Such as like the increased salt cap, or other areas.
Yeah, I mean, my feeling is they have a really hard job with the salt and with the pass-throughs. And the pass-throughs are important to members. And here they're kind of doubling down on the idea that some pass-throughs are different than others. And so back in 2017, when they were reducing the corporate rate to 21% and the pass-through rate was, the top individual rate was 37%. There was a lot of concern about that disparity. And so they dealt with that by putting in the 199A, but the 199A QBI deduction, it didn't allow specified services like investment management, financial services, people like myself, accountants, lawyers. And it had a wage cap. So the idea is you should be employing other people to get this deduction. And so they gave them that special rate. Specified services were out. And then we had this whole, evolution of the PTET. And so what they're doing here is they're taking it away, right, from those specified services. And then so they're just making it more complete. Their bifurcation between these, businesses that they view as these are the types of businesses that we want to favor, and these other types of businesses that we don't, that we feel like these other types of businesses, do they think they're just more like they're just more like working for themselves or employees, and they shouldn't get these special goodies. I think it's partly philosophical, but more about the money. And we got to make these numbers work. And we're really doubling down here in this administration. We really want production in America. And so we're putting our eggs into that basket. And so that's what's a little funny about this 199A, because you'd say, well, maybe they're trying to give a little more 199A to offset the PTET, but the people that get the 199A also still get the PTET. So they're just sweetening that pot a little more and then taking away from this other pot. So I think it's mostly about the numbers, but also that they are trying to advantage, certain types of businesses above others. And of course, that's, a lot of us feel like that's like the kind of tax policy that we'd wish we didn't pursue. We wish we had something more neutral, but that's where they're at right now.
Yeah.
And then the other thing I think that's key for the pass-through businesses, which I mentioned before, is this excess business loss provision. It's very unfavorable. It has a lot of our clients very concerned because, if you've got, portfolio income right now, you can just use your NOL the next year, but this puts you in, hey, I'm never going to be able to use this unless I have some business income. And so thinking about the way you're structuring transactions, what's your exit going to be? Can you still afford to invest in these kind of more startup pass-through ventures that you're doing? I think is something that the folks are really concerned about among our client base.
Yeah. Well, certainly I can see why. And I think there's, lot of planning opportunities there, I think, once it comes to fruition. But just a couple other questions I wanted to try and get to. And then there was actually another one just came through. But okay, for the 3.5% excise tax on individuals sending funds overseas, does it matter if both are U.S. citizens? For example, a parent wiring funds to a child living overseas. Is there a threshold, and does that come into play?
So it seems like the only potential exception to this withholding is where the sender is a U.S. citizen. So if a U.S. citizen is sending money to let's say their child who lives overseas as a student or something, right? If they're sending it through a qualified remitter, then that type of remittance should be exempt. But let's say the parent is actually not a citizen, but a green card holder or other non-U.S. citizen sending money to a child outside the U.S., it doesn't seem like there's any intended exception there.
Okay.
Yeah.
All right. Interesting.
So I think the provision raised like $4 billion. It was not a huge amount of money. It's getting a lot of attention. But I haven't heard any kind of public statements about it. It was one of those that kind of just appeared in the bill. Like a lot of the revenue raisers, they were very closed. They kept very anti-leak. No, they didn't have a lot of warning about what revenue raisers would be in there. So that's one that I hadn't really been hearing a lot of chatter about it until it appeared in the bill.
Okay. A couple other questions just came through. So, one, why are charities always untouchable? A lot of them seem to have very large endowments. So I don't know if you want to.
Well, maybe they're not this time. We'll see. I mean, certainly getting a lot of attention where you're potentially pushing the net investment income on large private foundations up to 10%. Keep in mind that, the corporate tax rate is 21%. And then on these large private university foundations, I think we're seeing, I think there have been some longstanding policy concerns about them. Even in the TCJA, we saw these net investment income taxes first arise, and we saw some different provisions. So I don't think this is coming only from President Trump. But including a 21% excise tax on university endowment income, it's pretty much just treating them like the same as if they were a C corporation.
Right. Okay. Well, I guess a couple more since we have a few more minutes. Are there any changes to the generation skipping tax that you're seeing?
I didn't see any changes other than the fact that the raised thresholds would affect that too.
Okay. All right. So let's see, one more here. Often view interest rates from an individual planning perspective, such as like borrowing costs and investing and so forth. But how might this bill consider the impacts of longer term government debt and interest payments given the current rate environment?
Yeah. So one thing I think I noted before is the bill would put a new limitation on itemized deductions to limit the value of those itemized deductions to 35% for those in this 37% bracket. Now, however, that would not apply, that haircut would not apply to investment interest expense. So this bill wouldn't have any impact on the deductibility of investment interest expense via current law. Trader business interest expense would be subject to the new base. So the ability to deduct that may be less limited than it is But I think your question goes at, well, what what about the economy? And of course, I'm not an economist. We've seen a lot of coverage over the last few weeks about, hey, the tax bill and what's the rate on long-term treasury bonds, and what are people trying to say about our government's creditworthiness, and how does this tax bill implicate that? And I think there's been some media coverage there. I don't know. It seems to me a little curious, right? Because we always knew this tax bill was never going to be revenue neutral. We've always known this. So this tax bill was not information that was different than what the market should have already been expecting. And the deficits and the spending are gigantic compared with the marginal impact of this bill. So I think it's also, in the scheme of things, my view would be that it's fairly small. But I guess we'll just have to wait and see, how this goes forward, and then where interest rates go. And I myself am not, I'm not an estate planner, but some interest rate driven transactions are less effective with higher rates, while other ones are more effective with higher rates. And so we see GRAPs, CLATs, installment sales, intra-family loans are less effective with higher rates. And we see, CRTs and QPERTs are more effective with higher rates. And so you just got to watch it. I would say have your plans ready, be ready to implement, when the rates hit a level of whatever you're trying to achieve.
Yeah.
I don't know, Rob, you may have more to add on that.
No, not necessarily. No, I mean, you hit on it.
Yeah.
So, but yeah, just being proactive with planning is huge, right? And I think the beautiful thing here, Mary, is it looks like we're going to have possibly as much as 6 months to get ahead of this, right?
I mean,
Where we had, what, 2 weeks last time? Something like that?
the other thing is we are, most of this. So we had some items in the bill that were beneficial, particularly around the business side, like the bonus depreciation, the research expensing, the 163 change that were retroactive really to the beginning of 2025, inauguration day for the bonus depreciation. But so we see some benefits going back to the beginning of the year. And for businesses, you may still have time to do some planning for 2024. You might be able to make some changes to the way you present things on your 24 return to kind of take advantage of the situation of, well, I was going to pay cash taxes in 24, but now with all these changes, I won't owe cash taxes anymore in 25. So it'd be better, like, I don't pay a lot in 24 and then have losses in 25 and going forward. But then on the individual side, a lot of things would take effect starting in 2026, and we still have plenty of time here in 2025. Potentially we even have the legislation signed this summer, which gives some lead time for planning, doing things differently in 2025, and really finding a way to optimize each own taxpayer situation.
Okay, so one last question. Crystal ball here. What's the last few in, last few out? If you had to, kind of give it some thought about what makes it in, what doesn't make it, at this point.
Oh, that's a hard one. I'm optimistic that the individual 37% that holds, that we don't see a higher rate, even though there have been a lot of rumors and discussions. Maybe I'm just deluding myself. I'm optimistic that they'll make changes on the excess business loss rule. I'm not as optimistic on the PTET rollback for the services. I think that one's a big dollar amount, and I'm not sure, that many lawmakers really care about us accountants on our PTET. So I think it's going to be a lot of drama, right, going forward as this heads into the Senate. The Senate's just coming out of a recess next week. Some of the Senate committees are going to do a markup of their sections. We don't envision that the Finance Committee, which handles the tax piece, we don't envision that the Finance Committee will do a markup. That's just like too much drama. And so there's a feeling that we won't see the Finance Committee, the tax provisions, until the final bill hits the Senate floor.
Yeah.
So I think there's going to be a lot of drama. We'll see how well they, kind of keep a lid on things and do their negotiations behind closed doors. I think their hope is that they do enough negotiating amongst themselves and also with the House side so that whatever hits the Senate floor they already know that they had the votes in the House and the Senate, and that none of us, I'm not a lobbyist myself, but nobody over on K Street will see what those tax provisions are until they hit the floor. That's what I think they're aiming for. So there's a lot of things going on behind the scenes, a lot of meetings and people working on different provisions, but I think we're not going to have a lot of new information, and that whatever comes out will probably pass.
Okay.
Yeah. A little scary.
Yeah. Yeah. Definitely. Well, we'll be paying close attention for sure. The next couple months are going to be interesting ones, and as I mentioned, no shortage of planning opportunities coming for us, down the pike. But Mary, Rob, this information has been great. Thank you so much. Everyone here on the call, hope you found this helpful and informative. Hopefully you were able to find a couple, good nuggets you can take away. And address with your advisor at some point. And then also if you're a fellow practitioner, hopefully you found this to be, valuable and good information that you can share with your clients. So, with that, as always, please feel free to reach out to us here at JFS. And, if you have any questions that we didn't quite address and, need to loop back in with Mary and Rob, happy to do that. But thanks so much for your time this morning, and hope everyone enjoys the rest of your day.